Good afternoon, everyone. The title of our paper is Rules and Judgment in the Oversight of Bank Accounting Practices. This is joint work with Andy Meyer and Drew Dahl. We're members of the Community Bank Research and Outreach Group within Bank Supervision, and we have a fourth contributor, Richard Jensen, who's from Utah State University. I'm obliged to give you the standard disclaimer that the views expressed in this paper are those of the authors and not of the Federal Reserve Bank of St. Louis nor the Federal Reserve System. Okay, Cecil is coming. I think most people know what Cecil is, everyone's favorite new acronym. So that's what our motivation is, trying to assess the effects of Cecil for community banks. So what we wanted to do is look at the introduction of Cecil to the banking industry. It's an arguably more complex accounting standard than the model that's being used right now. And it's being introduced at the same time that bankers and regulators are all talking about reducing regulatory burden. So we're looking at the introduction of an arguably more complicated accounting standard at the same time we're talking about trying to reduce the burden on banks. So we're looking at that juxtaposition. Regulators, for their part, have been trying to assure community bankers that this new accounting rule will be scalable or tailored. They'll use discretion, judgment, all those words that kind of mean the same thing, that there's no reason to be so fearful of Cecil. So we thought it was reasonable to ask if community banks can feel confident that this tailoring will take place. And we thought one way to perhaps answer that question is to look at how current accounting rules are applied. Is there tailoring with current accounting rules for community banks? Does one size fit all, which is the fear that everyone is going to be put into the same bucket and everything is going to be judged exactly the same? So we wanted to look at if there are differences in how small banks comply with the current accounting rule, presumably with regulatory approval, and large banks. Is there a difference there? So the purpose of our paper is to try to answer that question with some caveats. So our contribution, what we seek to do here is to see if there is empirical evidence in the banking data, call report data, that indicate banks behave in the ways that we would expect given accounting rules and regulatory rules. Spoiler alert, yes they do. Loan loss provisions are strongly correlated with subsequent charge-offs. That's the basic model that we follow, and we do find that in the data. We also find evidence that there is tailoring for community banks, just the use of discretion. We see deviations between the strict conformance with the rules for small banks versus large banks, so we do see evidence of that. Further, this tolerance for this deviation between the rule and what's actually recorded occurs over an extended period of time for large segments of the industry. We're not talking about short-term forbearance for a large bank that's going through a particularly rough time. This is a sustained tailoring for a large segment of the industry, especially for the smaller banks. So a little bit about Cecil. First, why are we changing accounting standards? Well, after the financial crisis, there was a recognition that there needed to be a greater alignment between financial reporting standards and what the users of the financial information wanted, that those two things weren't exactly aligned. And so this process began shortly after the financial crisis, and it's taken all this time. There was some coordination with the International Accounting Standards Board, and we ended up having slightly different standards, what FASB came up with and what the ISAB came up with. But that was the consensus, was that the information that was being recorded at the time of the financial crisis was kind of too little too late, that there were embedded losses that weren't being recognized, and they thought that they could do better. And so that's why we're having a new standard, Cecil. They wanted to incorporate more forward-looking information. So the model that we've been using since the mid-1990s is called the incurred loss model. And the standard there was that you're supposed to record expected losses for loans where you think the loss is probable. And the idea behind Cecil is to move more to an expected loss versus a probable loss. It's going back a little bit further. So Cecil applies to all financial institutions, banks, thrifts, credit unions, everybody, regardless of size, basically any financial institution that files their reports in accordance with GAAP. It applies to all financial instruments that are carried at amortized cost and all off-balance sheet items that are not accounted for as insurance, such as standby letters of credit and loan commitments. There are some modifications for available for sale securities. I'm not going to go into all the technical details. I'm sure you all have the many, many bulletins from FASB about how this is going to affect what you do. So the main standard that they're describing when accounting for loan losses under Cecil is that your judgment about expected losses should be based on past experience, current conditions, and what they call reasonable and supportable forecasts of future losses. So those three standards. So what did we do? As I said, what we wanted to do was to see how banks conform to current standards. And we wanted to see if there was any indication that, especially for small banks, there's leeway, that there's not an absolute strict conformance between the rule and what's reported. If there is, I think that gives some credence to the notion of they say they're going to tailor. They've tailored before, so we have reason to believe that they'll do it again. So that's the basic prospect that we're looking at. So under the incurred loss model, banks are instructed to use estimation procedures in setting loan loss provisions that reduce the difference between estimated losses and subsequent charge-offs. So that relationship between what you're setting aside in loan loss provisions this period feed into charge-offs in the next period, that those two things should be linked. So we didn't come up with the model that we use on our own. There have been a number of accounting researchers who've done this in the past. And what we wanted to see, first of all, were charge-offs and loan loss provisions directionally consistent. So if loan loss provisions rise in period 1, do charge-offs rise in period T+1? If provisions fall, you would expect loan loss charge-offs to fall too. So that's the first thing that we looked at. We also looked at other factors that might affect the relationship between loan loss provisions and charge-offs, things like the size of the bank, whether the bank was externally audited. There's reason to suspect that the more accountants that are looking at your books, that might make a difference in how you report things, and the effects of management, the quality of management. So the basic equation that I'm not putting up the official equation, I'm just showing you what we estimated. It's, again, based on this relationship between loan loss provisions and charge-offs. This relationship is prescribed by the FFIEC. It's what bankers are told to use when doing their call reports and coming up with their financial statements. So we wanted to see how these relationships accorded with the theory of how banks react and empirical evidence from the banking industry. So what we wanted to do was we wanted to run tests to see how much net charge-offs depend on prior loan loss provisions, bank size, whether the bank is externally audited, the prior management rating, CAMELS rating, the M from CAMELS rather, prior loan loss reserves, prior non-performing loans, the probability of a downgrade in CAMELS rating, and loan concentration variables. So things like a bank, differences in a bank maybe that's very heavily involved in commercial real estate or heavily invested in commercial loans. The sample that we used, we started in 2006 after the issuance of the most recent accounting guidelines, and we end in 2015. So we have 10 years worth of annual data, all under the same accounting standard for loan loss provisions. We removed outliers like negative provisions, divided the banks into quintiles, groups of 5, so that we could account for different behavior accounting behavior among banks of different sizes. We wouldn't expect very small banks to behave the same as very large banks. We computed averages to look at the basics of our data, and 2 points that stood out. Smaller banks have lower ratios of loan loss provisions to total loans and net charge-offs to total loans than do larger banks, even when they have similar ratios of non-performing loans to total loans. So that difference, those lower charge-off rates and lower loan loss provision rates, can't be explained by more poorly performing loan portfolios. There's just a qualitative difference, and quantitative and qualitative difference there. We also saw in slicing and dicing the data that smaller banks overall have lower probabilities of downgrades to their CAMEL ratings than larger banks do. So these two stylized facts about our data may affect regulatory judgment of the adequacy of loan losses. All right. So our results of one of the equations that we ran, where the dependent variable that we're looking at is LCO is loan charge-offs. And I'm not going to go through all the results. The most important ones are in the first two rows. The first variable is LLP T minus 1. That's loan loss provisions in the prior year. So as you would expect, according to theory and what we know based on the data, is that we find a positive relationship between loan loss provisions in the prior period and charge-offs in the next period. So the money that you set aside this year is reflected in charge-offs the following year. So we find that directional consistency. What goes up on the right-hand side goes up on the left-hand side. We find that this is statistically significant, meaning that it's very unlikely that this relationship is due to chance. It seems to be a very real relationship. The other thing that we were interested in is the interaction between loan loss provision and size of the bank. So that's the second variable. We expect the coefficient on this variable to be negative if charge-offs of banks in the smaller size categories diverge more from prior provisions relative to banks in the largest size category. So for the very smallest group of banks, the banks with less than $63 million in assets, the coefficient is minus 0.19. That indicates that that variable is further away from the value than for the larger institutions. It's negative and statistically significant. So it indicates that the divergence between loan loss provisions and net charge-offs increases as bank size decreases. So there's less of that one-to-one correspondence between loan loss provisions and charge-offs for the very smallest institutions than for the larger institutions. So that's an indication that there's less strict conformance for smaller institutions, according to that basic rule. Prior loan loss reserves, prior non-performing loans, and the prior probability of a CAMEL's downgrade are also positively related to the current period's net charge-offs, but they exert a much smaller influence. So those last three rows on the table, those variables are all positive, and they're statistically significant, but they're very, very small compared with the first two results that we report. And what we found is that these results held regardless of the management rating. We divided the data up by CAMEL's rating and looked at 1 and 2 rated institutions versus banks with 3, 4, and 5 institutions, and the relationship held regardless of the management rating. And audit status, it also held whether the banks received an external audit or not. Although it's important to note that banks that do have an external audit had a tighter relationship between provisions and charge-offs, so that the audit did appear to have some effect there. So our key findings were that smaller banks have lesser capacity or incentive to link provisions with subsequent charge-offs. And that also appears to be their incentive or their ability, and it also appears to be tolerated. Oversight by auditors improves the association between charge-offs and provisions, but not having an external audit doesn't make that go away. This accounting discretion that we see holds up for small banks across all management ratings. So it's not just one banks that are given this discretion by regulators. Banks of all CAMELS ratings receive this discretion. So it seems to indicate that there's a greater tolerance of regulators for a wide range of outcomes among smaller banks. Again, this one size doesn't fit all. So the main takeaway is that the qualifications in the FASB standards for GAAP, as well as the guidelines that are devised by regulators in conformance with these FASB standards, are flexible enough to accommodate differences in how big banks and small banks prepare financial reports. So to the extent that the past is prologue, there's every reason to believe that this flexibility, tolerance, tailoring, scalability will occur under Cecil as it does under the current accounting model. Thank you.